All right. Hello, 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 hello. We are going to discuss divergence today. Excuse me as I share this with my teams. Hope everyone is having a great day. Oh, let me lower my speaker so there's no crazy feedback. All right, there we go. Awesome. All right. So today I want to talk about divergence. Divergence is something that I don't recommend people use as an automatic indication to get into a trade, but it's a great way to see if the market is losing volume and if we're going to have a change in the trend. Let's see. Here we go. Now, I pulled up mini gold futures because I know a lot of people like to trade gold and it's just easier to do. And I have an example of both bearish and bullish divergence. So we get sometimes like the market will move sideways and consolidate, or we'll get triple bottoms and triple tops. Now, our advanced traders, we usually know how to get into these trades and take them down. And you can see here in the example that I have on the left, this one right here, that I have a higher time frame level here. This is a 1 hour level, and you can see multiple times we have rejected that resistance. So just that alone in itself was letting us know that we're going to get a push down. Anytime you have slippage outside of a level and it comes right back down, that is not a sign for you to get discouraged. A lot of people like to trade like a break of structure and automatically think they're going to get in on the next candle. You have to be careful anytime you're trading breakout trades because it can come back down or do retests. And then also you want to wait for candles to close. So if you ever get caught up in trades like this, you want to wait for it to come back down and do like a retest underneath the level. Those trades usually pay out really well, and they typically have a really strong impulse after that happens. So for your bearish divergence, let's say you get into this, you thought it was going to go up and you're like, man, like what's up? Like, I don't understand why it didn't go up. That's okay. It didn't go up. You were wrong. It is what it is. Now I have the stochastic RSI indicator located at the bottom, but you can see where we have a higher high being created through price action. And, someone may think that that's going to go up, especially if you sit here and you draw like a miniature trend line. It's like, oh, yeah, no, I think it's going to go up, but it's not. It's rejecting that 1 hour structure. So if you look at your stochastic or your RSI, there's other indicators that you can use. Notice that it has created a lower high. So our actual price action created a higher high, and our stochastic RSI created a lower high. That is called bearish divergence. So what that is indicating is that even though the market has created a higher high, there isn't enough volume to push it up. Does this automatically mean that there's going to be a reversal? Nope, that is not what that means. This could be just a minor pullback. We don't know. What helps me understand that we're getting a bigger push down is that it has rejected a higher time frame level multiple times. So the higher the time frame, the stronger that level is going to be. If it's a 4 hour, it's going to be harder for price to break that level. It's going to need more volume. Same thing here. A little bit of slippage comes right back underneath and gives us a nice big push down. So to spot divergence, bearish divergence, you're going to look at the highs of your market, the price action, and you're going to compare it to the highs on your oscillator. Okay. And again, this is the RSI stochastic. You can do one or the other. It doesn't have to be combined. Now let's talk about bullish divergence or hidden bullish divergence. Over here, you can see where the market is pretty much just creating equal lows. But if I look at my indicator is creating, right? My oscillator, excuse me, is creating higher lows. If you look at this low here, bam. This low here, it's a little bit higher, not too noticeable, right? And then we go to this high, which is technically a bit higher. It actually moves quite significantly. It moves in the middle of this indicator, right? Right in the middle. So that bullish volume, that buying volume is starting to kick in. and it's letting you know it's about to go up. Now, if you're an experienced trader, you know what a double bottom is. You know how to trade this. But a lot of people don't know how to identify if there's going to be a shift in momentum. And you can use this to help you do that. And that's exactly what happened. So this is a hidden bullish divergence because the market basically created equal lows and it created higher lows here. Now, if it was regular bullish divergence, what would happen is we would need the market to create a lower low. And let me see if I can find an example. Here we go. Look at here how the market creates a lower low. But if we go to our stochastic RSI, oh, I want to use this one, it is actually creating a higher low. So yes, we got that lower low, but our indicator is giving us a higher low, letting us know that we're either going to get a pullback or it's going to push up more. And that's exactly what happened. So this is regular bullish divergence. Okay, so bullish divergence is when your market, the price action is creating a lower low, but your indicator is creating a higher low. Bearish divergence is a higher high being created, but your indicator is creating a lower high. Hidden bullish divergence is when the market has equal lows, but your indicator is creating a higher low. So we also have bearish hidden divergence, and bearish hidden divergence is basically when you have the market just moving the same. I'm trying to find kind of just consolidating. Of course, I want to show you one. It's not going to pop up. Okay. And well, I can't find one at the moment. I wanted to give you one, but I'll just explain it. So when you have bearish hidden divergence or hidden bearish divergence, you're basically getting a double top, like it's just equal highs, but your indicator is creating lower highs. Okay. All right. So that's that. The next thing I want to talk about is market structure. So I went on Twitter and I told people about how I see a lot of traders struggle with market structure, and I have assignments on this. I've been teaching this for years. It is a great thing to learn and it helps you become a stronger trader. But with market structure, what you're looking for is you're essentially looking for the market to create new highs and new lows. And if you take whatever it is that you're trading, ideally you want to be on the time frame that you go, you enter your trades. For your bullish momentum, you want to identify the highs and just draw an arrow and drag it over to the right. And you want to see price essentially respected. Now, if I'm on a smaller time frame for entries, I like to see a 2-candle retest preferably. So I like to see 2 candles respecting that area before I get into the trade, unless that candle is something I'm really confident in, like hammers, spinning tops, dojis. Those I feel good about them if they're only 1 candle. However, I like to see at least 2 candles respecting that area if I am trading on a smaller time frame. So 5 minutes and below, I like to see 2 candles respecting the area before I enter the trade. There are times where I don't do it, but that's what I like to do. Okay, so today someone in the free course asked, I have my levels marked up, but I don't know, how do I know when to get in? Well, number one, you're going to have to practice and you're going to have to keep executing because you're not going to know if it works or not. Watching charts all day is not going to make you a better trader. You have to see if you have the confirmations you're looking for. So for example, we have a break and retest of this structure. We have a rejection candle here. We can also see that an engulfing candle failed to break through this level. That's really important. Okay, because when an engulfing candle cannot break through that area, that's letting me know, all right, this is a strong support. It's now a strong support. Wait for one more candle to give me that rejection. Get in on the next candle, put your stop loss slightly below the previous candle, or you can use market structure, whatever it is that you like. Same thing here. You can see in this case, we had multiple candles rejecting the area, kind of consolidated, not the prettiest, but it ended up going up. Okay, over here we had only 1 candle retest before it went up, and then we can start to see where, well, here goes your hidden bearish divergence. We can start to see where we have kind of like your equal highs, but if we look at our oscillator right in that same area, look at the huge difference from this high to this high. So there's a huge change in that momentum. It's starting to go down. And that's exactly what happened. The market failed to create a higher high and now made a lower high, and it's coming back down and it's creating new structure now. So that can help you identify if you want to exit a trade or if you feel like a possible reversal is coming. It's very helpful. So I just wanted to show you guys divergence and utilizing it with market structure so you can kind of just get an idea of what's going on. Again, I don't use divergence as like a must-have tool or must-have confluence to get into a trade, but I do understand that when you're new, it sometimes may be hard to identify these things. Ideally, I feel the less indicators, the better. That's just my opinion. But if you need some type of visual to help you with that, I hope this helps. All right, guys, I'm out of here. Bye.